Hey there, everyone. Happy Thursday, May 22nd. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautifully sunny and wonderful Redmond, Washington. Hope you guys are all doing well wherever you're tuning in from. Thanks to those of you tuning in live on Facebook, LinkedIn, YouTube, and X. Pleasure to have you joining me. If you're watching the replay on our YouTube channel, I appreciate you as well. As we go along through the market recap, through the heat map, and through the charts, drop any questions in whatever comment section of whatever platform you're on. I can see all of those here live, and we'll take a question or two at the end of the episode. We are planning an all mailbag episode tomorrow. Some really good questions already this week. Hopefully a couple more from today's show, and we'll have a lot of great things to talk about. You know, kind of an underwhelming day, and it looked like actually it was going to be a pretty decent finish, but the last 30 minutes, basically the S&P and the major averages gave back all the gains they'd experienced in the afternoon. So the S&P finishing slightly lower. The breadth not bad, but not good. Sort of, more stocks down than up in the S&P 500, as you'll see in a minute. Some growthy sectors back to the top of the list. So plenty of things to talk about for sure. With that in mind, let's get to the market recap and see how things played out. Here's the S&P 500 to start, basically flat for the day. I mean, less than 3 points down. It's just a tiny, I mean, less than 0.1% of a move. So it really was unchanged, but you can see basically the acceleration to the downside that happened in the last 30 minutes of trading. I mean, that's not great, right? Because as we mentioned before on the show, last 30 minutes of trading is really when institutions tend to be more active. This is when you're tending to, if you have a larger volume that you need to move, you kind of wait to the end of the day to minimize any sort of, shock to the market. You don't want to destabilize things as you're trying to get filled. And so market rolling over into the close, usually not a great feel. It's not what we're looking for. The NASDAQ composite sold off as well in the last half hour, but did finish slightly higher, 0.3% to the upside. The Dow almost exactly where we ended the session yesterday. So that leaves the S&P at 5842 here as we get toward the end of this week. I mean, it's really been more of a sideways, choppy week more than anything. Although yesterday certainly was a fairly significant decline relative to what we've seen in recent days. Mid caps and small caps slightly lower. Again, not a huge change anywhere. The VIX moving slightly lower as well. So that sell-off at the end of the day, really wasn't enough to push the VIX much higher. Earlier in the day, it was up above 21, but finished today just above 20. So we're sort of right at that level. That 20 level is that important level that we follow, and sort of anything above there, higher volatility, anything below 20, kind of a low volatility, not much to worry about sort of session. So yesterday we pushed back above the 20 level. Today finished above there as well. Something we'll have to continue to monitor here, maybe going into next week. Looking elsewhere, we can see bonds prices moving higher. TLT was up about 0.5%. That's a Treasury bond ETF. The dollar was slightly higher as well. Now that's bouncing after yesterday. We highlighted on the show the bear flag, which I think is a confirmed bear flag, which suggests weaker dollar here. We'll see if that continues. But dollar index today, bit of a bounce higher, slight bounce. Interest rates generally moving lower. So all of these are sort of contrary to what we saw yesterday. Yesterday we saw bonds selling off. We see rates go higher. We see the dollar pushing downwards. Dollar rallied into the rates pushed higher into the close yesterday. Today kind of coming back a little bit. So the 10-year point around 4.55, the 5-year yield just above 4.1%, the long bond yield remaining above 5%. I'm seeing a lot of chatter with the long bond yield going back above 5%, and up getting close to multi-year highs, pretty significant highs in rates. A lot of discussion about how that weights on home builders, 100%. I mean, the charts of home builders are not particularly great right now. They haven't been for a while, but rates getting up to these levels means anyone trying to open a new mortgage, it's a lot higher than you probably want it to be, certainly compared to recent history. So higher rates, higher borrowing costs, usually not good for home builders, and other things as well. Often puts pressure on consumers who are, borrowing money, obviously, for a lot of things these days. Looking at the commodity markets, we can see gold and silver slightly lower. The GLD was down about 0.9%. Still pretty close to all-time highs, but recently bouncing off of the 50-day moving average. We, I think, shared that chart yesterday. Crude oil prices coming down a bit. Energy was one of the worst sectors today, with others undercutting it slightly. I tell you where there continues to be plenty of strength, the cryptocurrency space. I interviewed Chris Verone earlier today from Strategas Research Partners. We'll have that episode out for you, our latest episode of the Market Misbehavior podcast, hopefully tomorrow. Chris is awesome. I've known Chris for a number of years and had a great conversation about a lot of things. But, he was sort of bearish on gold, bullish on cryptocurrencies, and talked about that pivot between the two. Earlier this week, I interviewed Jesse Felder of the Felder Report. That episode is live. You're welcome to check that out on our YouTube channel. He talked about selling gold to buy oil or oil stocks, and basically that sort of rotation. So a lot of experts I'm bringing on telling me gold has probably had its run. So for me, still with a decent sized position in gold, I'm certainly listening. Might lighten that up here at some point. I haven't done anything with it yet. But boy, cryptocurrency is pushing higher. Bitcoin hitting 112,000 today. Got the chart of Bitcoin and a quick story here when we get to that chart in a moment. Ether price is pushing higher as well. Now, Bitcoin has been outperforming Ethereum for a while, but Ether having a better day today, just above 2,600 today as we go live with the show. Looking at the 11 S&P sectors, we can see only 2 of the 11 in the positive. Most sectors were down today. So the sector breadth, as we call it, not particularly strong today. Most sectors down. Consumer discretionary up 0.4%. Technology and industrials basically flat from yesterday. They were right around the zero level. On the downside, utilities the worst performer. That's down 1.4%. Healthcare down 0.8%. Consumer staples down 0.4%. So kind of a offense over defense shape to the day today, but most things in the red. So this is not a great day overall for risk assets, I would say. Not an end of the world bad day, but certainly the sectors at the bottom, notably healthcare, stand out as having some pretty sort of chart challenged, as one of my former analysts used to say previously. Looking at the breadth conditions and the major averages, the S&P 2 stocks down for every one that was up. So about 63% of the S&P lower, 37% higher. In the New York Stock Exchange, sort of a broader universe, a little more even, but 53% down, 44% up. So none of these had positive breadth today. These were all a little more negative. This is kind of what this week has felt like. I mean, these aren't horrible down days where it feels like, uh-oh kind of days. We're just not going up anymore. And I think of this as a market that's stalled out. As you probably know, if you've watched any of my content for a period of time, I'm a student pilot, and I love to relate lessons from flying to lessons learned investing. There's a thing called a power on stall, and I'll get to the chart of the S&P to make this case here in a moment. The power on stall here, let me show you. The power on stall is where you're going up, and this actually happens often when you're taking off, right? You're taking off of a runway, you're full power, you're trimmed for takeoff, meaning you're just trying to get the plane off of the ground and you go. And what happens is if you're at full power and you tip the nose too high, what happens is a plane flies because of what's called the angle of attack, right? So this wing, this airfoil goes into the wind, and the wind pushing into the airfoil creates lift, and that's what causes the plane to go higher, basically. And power on stall is if you make that angle too steep, all of a sudden that process, the going into the wind, doesn't produce lift, and basically the wings don't push the plane into the air anymore. And what happens is you go down. And so when you recreate those conditions, which is what you're trained to do to sort of learn what it's like, you do this stall where you're basically up in the air, you go up thousands of feet and you recreate it. So you go full power and you tip the nose way up. So it's like you're trying to go higher, but the plane's just not really gaining altitude anymore. And there's just a couple seconds where you're just kind of sitting there before the stall occurs and the nose dips down very quickly. That feels a lot like what the market looks like right now with this rally, the gap higher over the 200-day moving average, and then this sort of power on stall kind of configuration, which is, we're on full power, but the nose of the airplane is just kind of coming down a little bit. Now, a savvy pilot and hopefully a savvy market is able to minimize a loss of altitude before you regain and start climbing again. if you do the wrong thing in that situation, the nose dips down, and it's kind of an issue. We'll see which of those plays out here in the actual market environment. Looking down at the Magnificent Seven and friends, let's see. We've got Tesla, Alphabet, both up a decent amount. Tesla up 2% today, almost. Alphabet up 1.4%. The chart of Alphabet not as ideal as you want, though. It was up a lot more earlier in the day and actually came down to close toward the lows. I wrote about Alphabet, I believe that was this morning. It was for CNBC Pro. If you follow my work over there, we had some charts of Alphabet to share. On the downside, two of the Magnificent Seven stocks going down. Netflix, which has been the best performer of this basket, down 0.6%. Apple down 0.4%. So those are the two names that are lower, while the rest of the stocks doing okay. Kind of a sort of choppy, quiet day, I would say, overall, when you look at the 1 day action. All right, let's look at the market carpet, the heat map style visualization. As a reminder, I can see comments coming in on any of the platforms upon which we are streaming. So please keep your questions coming. We'll try to take a question or two at the end. And then any of the questions we don't get to, we'll put in the mailbag. We're planning an all mailbag episode on Friday tomorrow. We'd love to answer one of your questions on the show for sure. We already have some pretty good ones from earlier in the week that we didn't get to. We'd love a couple new ones. Looking at the market carpet here, looking at the heat map style visualization, not great. And I would say as you're looking at the conditions here, a lot of kind of neutral amber right now. You can see from the breadth conditions, they weren't great today. And certainly the sell-off in the last half hour changed the configuration of the heat map slightly, right? It was a little more positive until a lot of things sort of rotated lower. But what stands out on the upside, I would say in technology, couple charts that stand out to me, right? PANW, Palo Alto Networks. Now, this is a stock that's pulled back here this week. And so bouncing after yesterday's pretty steep sell-off. So that might be something to watch. Seagate Technology is an interesting one because yesterday we're testing new 52-week highs above 110, 111 this week. Yesterday pulled back to around 105. Today, sort of regaining all of yesterday's sell-off. So up another 4.25%. CrowdStrike is one. I didn't grab it for the chart review portion, I don't think, but I did think about it. CRWD, sort of testing new all-time highs, not quite getting above 450, but trying to do so. I would say is how I would look at that. Now within that same sector, within technology, we can see the biggest names: Microsoft and Nvidia up slightly, Apple down a little bit. There were some stocks in the red, though. I'm looking at Qualcomm here, down 2.6%. Qualcomm's not been a particularly strong chart, kind of underwhelming compared to the other technology names that you probably know and love, but has been making a short-term pattern of higher highs and higher lows. So after making a new swing high earlier this week, we're pulling back a little bit, maybe making a higher low, something to look for. Elsewhere, we can see renewable energy names, Enphase, First Solar, both pulling back. These have been obviously in the news a lot with a lot of legislation, or I guess the better way to say that is policy changes or announcements related to renewable energy. Some of those solar names actually gapped higher and did a little bit better, but rotating lower as we prepare to get ready for the show here. Hold on, let me get one more chart here. I forgot to save a chart to the list. There we go. All right, that should be better. What else? So in technology, the other one I wanted to point out was On Semiconductor. Semiconductor stocks have struggled a bit as of late, but On Semiconductor has rallied off of that early April low, sort of finding resistance at a previous swing high. Let's bring up that chart for a moment. Yeah, here we can see On is a maybe a very interesting chart here very soon. We have this swing high around 47. That was in late March. We then made the new 52-week low into April. We then recovered all the way back to that March swing high, and now we're sort of in that pullback phase. So sort of not an ideal head and shoulders bottom, or an inverted head and shoulders pattern, as we would call it. But no matter what, I think breaking above that 47 level would be really compelling. Hasn't quite happened yet. But I'm making a note to set an alert on that one, because that's one where if you do, when you have a clear resistance level like that, breaking above resistance really confirms that, kind of a renewed optimism, right? More buyers coming in. That's kind of the level I would be thinking if you're not there already. That's where I think you would start to maybe consider it. On the other hand, though, breaking down below trend line support, one of those things is going to happen here very quickly, maybe as early as tomorrow. Today's selling off into the close. That maybe tells us the primary direction, but we'll let the chart tell us. Other sectors to watch, I would say, in healthcare. Again, this has not been one of the better sectors. You have charts like UNH, obviously in the news and struggling. Eli Lilly testing 52-week lows and bounced off of it yesterday. Today, rotating back lower. Names like Medtronic making new 3-month lows. So I run a regular scan for stocks making new 3-month highs and stocks making new 3-month lows. Medtronic on the bad list today, sort of popping down there. Humana down another 7.5% today. This is a stock that was struggling to get above 300, consistent resistance right around there, now rotating down to the lower end of the range that we've been in for the last 6 to 8 months. That's kind of where I'm at with the heat map, to be honest. And generally, as I mentioned, this is a sort of choppy sideways day. At the end of the day, sort of a neutral color for most names. And on a day like today, what I like to do is focus on the brightest green and the brightest red. Those are stocks that are moving and doing something very different than the major benchmarks, and that can always be an interesting, basket of stocks to sort of consider. I'll do one more chart here. EA. I didn't grab this for our chart review, but we have talked about stocks like Broadcom, right, with their rally off the lows. Now, EA is a little different because it actually didn't bottom out in April. It actually made its low in January. So if you take that cluster of lows there from late January, draw a trend line connecting that with the swing lows there in mid-April, and then sort of continue that trend line on. This gives you a trend line that sort of quantifies this uptrend phase. And we could even make a parallel line like that and see that the peaks up here, not perfect, but lines up pretty well, right? So we can sort of see this uptrend channel of higher highs and higher lows. This is where I think trend lines can be super valuable, right? An uptrend channel is in place until it isn't, right? You wait for the chart to tell you something's different. And so the way that the price exits this channel, it could break above the upper boundary, but that's usually pretty rare because it would have to accelerate, have an exponential rise to do so. What's more likely is that we eventually break down below the lower trend line support. So I like drawing trend lines like this and just looking for a break below trend line support. That'll tell you at least whatever was happening here is starting to change, right? That trend is maybe evolving, and that tells you there's some room to the downside and still be within this primary uptrend. And I get a lot of questions about, that I think come down to time frame. Remember that these swings, which are very buyable and sellable, swings, are on a shorter term time frame, but those swings between peaks and valleys make a longer trend, and that's really, thinking about that interplay between tactical swings and longer term moves, I think, is where technical analysis can be so valuable to help you sort of relate how short term moves turn into longer term trends that can evolve over time. All right, we'll continue on to the chart portion, and let's look at the S&P 500 to start. As we've mentioned here a lot recently, we gapped above the 200-day moving average. I think that was pretty meaningful. We also gapped above that swing high from late March. I think that's pretty meaningful as well. Post gap, we had about a week of further upside acceleration. We can see that through, May 19th. That's that session here where we make, for now, what's the high for this swing. Last couple days, right? So far this week, we've sort of rotated off of Monday's peak and have made, a bit of a pullback phase. Now, for now, we're still, I would say, this primary uptrend is still in play because we're making higher highs, and for now, we're making higher lows. This shaded area for me, that's kind of the line in the sand area. I think as long as we hold that 57.25 to 57.75 range, any pullback can be labeled a garden variety pullback within a primary uptrend. We start to break below 57.50, below 5700. That would get below that gap support, and that would tell you this is probably something different. Charts like EA, we can draw trend lines off the lows. We can also focus on recent price gaps. A lot of stocks have a gap around Q1 earnings, which are sort of in that mid-April to mid-May period. I think holding those levels on pullbacks means this is probably still a constructive tape. Breaking those pullback levels or pullbacks breaking those support levels I think all of a sudden becomes a dangerous environment. Keep an eye on that and see what happens. Now, I love using a stoplight kind of technique. If you're wondering how I'm approaching a market like this, I think of things like a stoplight, which is really more how, I mean, honestly, a lot of financial advisors that I work with and have worked with kind of think of it more this way, right? When trends are strong enough, when there's enough of a bullish flavor to the markets, you want to be invested. When there's enough of a bearish market, you want to be out of the way. And so just recognizing where we're at within that cycle is pretty meaningful. Anything above 57.50, that's a green light in my head. That means we're in an uptrend phase. Anything between kind of 5,500 to 57.50, I think that's a yellow light. I think that's more, wait and see mode, probably start to get more defensive or at least take aggressive bets off. We break below 5,500. That tells you get out of the way because, 4,500 is a possibility, but we have to get through 5,500 first. So defining that level of risk, that level where you're okay staying in the market, anything below there, you really want to get out of the way. I think that's helpful. And it's helpful to set it up ahead of time. So you're not just surprised in making an emotion-based decision or emotion-based reaction to some sort of movement in the markets. Here's the McClellan oscillator. As we mentioned yesterday with the sell-off that we saw, most likely that the McClellan oscillator would go below zero yesterday, and it did. Given today's further deterioration in breadth, it looks like we'll stay below the zero level and probably go slightly lower today. So the short-term breadth conditions are getting less ideal, and I think that's one of the things that we talked about, right? When you have a market that's rallied so much off the April lows, three things I'm looking for. Number one, a breakdown in price. We talked about that with that gap on the S&P 500 chart and that stoplight approach. Second thing would be breadth deterioration. Breadth conditions, which have gotten very strong, start to be less strong. And when I look at the chart of the McClellan oscillator, I'm seeing a bearish divergence in May, right? In April, we have the market going higher on improving McClellan oscillator readings. Here in May, we're still making new highs, but the McClellan oscillator is diverging. It's sloping downwards. Now we're breaking below zero, which tells you the breadth is more negative than positive. So short-term breadth deterioration is often how a tradable top starts to emerge and starts to play out. Now, I would say one of the breadth indicators to really focus on if you want to differentiate what would most likely be a tradable pullback versus something that could be more significantly bad, looking at the bullish percent index of the NASDAQ 100 could be an interesting sort of secret sauce approach to look at. And here's why. The NASDAQ 100 index are a group of mega cap, large cap, growth oriented stocks, right? Amazon, Meta, Alphabet, Apple, Tesla kind of stocks. And if those stocks are holding up okay, then even if everything else is struggling, our benchmarks are so weighted to these names that they're probably going to still hold up okay, right? The S&P 500 overlaps with those biggest names, and the biggest ones have the biggest weights, of course. But if you see the NASDAQ 100's bullish percent index start to break down, that would tell you that those mega cap growth names are no longer going up. That will tell you that those mega cap growth names that have rallied so well off of their April lows are starting to stall out, and then it's really starting to rotate down because point and figure charts don't register a sell signal on just a little blip of a pullback. It really takes a downside rotation to trigger a sell signal using the point and figure methodology. So right now, I mean, earlier this week, 85% of the NASDAQ 100 names had a buy signal on their point and figure chart. That starts to go down to 70, 60, 50. That for me would be a get out of the way of this market rotating lower type of signal. Something to watch. Obviously, still pretty strong here as we wrap Thursday, May 22nd. Put call ratios kind of top of mind for me because they've gotten very, very low. This is the total put call ratio, so it includes equity options, also index options, but there is an equity only put call ratio, which is pretty frequent on stock charts. If that's your platform, $CPC is the total put call ratio. $CPCE is the equity put call ratio, but other platforms will probably have different tickers for those indexes from the CBOE. The raw data is in gray. These are data points that are reported every day, so it's actually quite noisy. So I usually do a 5-day moving average, which is what I'm showing in the foreground in pink. We can see that pink line and the raw data in gray pretty low this week. Actually, some of the lowest levels we've seen over the last couple of years. And you think of this as an inverse signal, right? So when the put call ratio is very low, that tells you the options market is super bullish, super optimistic, way more calls than puts. A lot of bets on the offensive side, and that usually is at the end of an upward trend. Put call ratios spike higher when there are a lot of puts, more heavy put trading, which means investors are making very negative bets, which usually means as a contrarian, we've sort of all the selling has been done. And we can see that where major lows in the price tend to coincide with spikes in the put call ratio. We can also see where very low readings in the put call ratio often indicates the end of a bullish phase. And I think that's what concerns me about what we're seeing right about now. Put call ratio is some of its lowest levels, and certainly retesting the lowest levels that we've observed in 2025. Last time the put call ratio was down at this point was in January, just before that peak in February. So, again, significant rally. Sentiment data like the put call ratio is getting extreme. Breadth data is starting to rotate lower. Let's talk a little bit about sentiment. And one thing I have to tell you is that the AAII survey, which is a survey of individual investors, net bullish. And you can see that at the bottom. This little one means there was 1% more bulls than bears. For the first time since January, we've got more bulls than bears in this weekly survey of individual investor. The bullish reading at 38%, the bearish reading at 37%. That tells you that more investors bullish than bearish. And it's been a long time since we've seen that sort of particular pattern. You can see the bottom. This is the histogram showing the spread between bulls and bears. Bullish for almost the entirety of 2024. Bearish or net bearish for almost the entirety of 2025. The last time we went positive was back here in mid-January. 2 weeks later, we flipped back to net to more bears than bulls. The level of bearishness has gotten all the way to negative, or all the way down to 60% bears. We're now down to 37%. We had down to only 20% of respondents bullish. We're now up to 38%. So over the last 3 weeks, investors in the AAII survey have gotten more and more optimistic on this rally. They're starting to believe. I don't want to tell you as a contrarian, I think that, the danger sign is all of a sudden investors all start to believe, and that's when things start to stop going up. Because we can see previously, obviously, right, when you've got bullishness up above 40, 50%, it's usually actually pretty good. That happens at the beginning of long-term uptrends as well. But something to keep in mind that you're definitely seeing a change there. Not a ton of a change in the name exposure index. The reading this week around 81%. Last week, we were around 71%. The week before, almost exactly where we were today. So I would say in the month of May, kind of consistent, right around an average allocation for equities in the name exposure index. All right, today is Bitcoin Pizza Day. Do you know what that means? I'll tell you what it means. May 22nd celebrates a day 15 years ago in 2010 when a programmer actually bought 2 Papa John's pizzas for 10,000 Bitcoin. At the time, that was worth around $41. And it's famous because those 2 pizzas, arguably the most expensive pizzas in history, because if you look at those Bitcoin right now, it'd be worth over $1 billion. Now, again, a lot's happened in the last 15 years, but that was the first time on record where Bitcoin was actually used in a retail transaction, at least that was actually tracked. So here's the chart of Bitcoin, the weekly chart of Bitcoin. The data on stock charts only goes back to 2014. So I'm showing you with the green dot kind of where the price of Bitcoin was when that infamous pizza purchase was made. So you had sort of a move up to that point. Here's where we're at today, 110,000 per Bitcoin. Down here is down around $20 per coin. So obviously quite about, $20 per pizza. That is a lot less for Bitcoin. It was down in the penny range. So obviously Bitcoin has appreciated so much, and the long-term story of Bitcoin is what's so fascinating. And again, 15 years ago to 10 years ago, it still wasn't that great. I mean, Bitcoin here in 2014, 2015, around $200 to $300, maybe $400 per Bitcoin back here. But we can see obviously the acceleration that's happened. When you go to the monthly chart, you can really appreciate the long-term story. A lot of the movements that we debate and discuss are short-term little blips within this long-term story. I've seen some aggressive upside targets for Bitcoin now that we're above 100,000. That seemed like one of those artificial limits we would never get above. Certainly the long-term trend is constructive. I own Bitcoin and Ethereum, but happy Bitcoin Pizza Day, May 22nd. All right, looking at sectors, my conversation with Chris Verone, again, as soon as that's released, I hope you can tune into that interview on our YouTube channel, but we talked about industrials. We're looking at different areas of the market that are showing strength. Chris is a big relative strength guy, which is probably one of the reasons why I really value his approach, because I agree wholeheartedly with how he thinks about leadership rotation and identifying areas of strength and weakness. We talked in particular about industrials. This is the relative performance of industrials, financials, materials, and energy. Here's energy underperforming since the April market low. Here's materials underperforming. Here's financials underperforming, all since the April 7th low. Industrials is the outlier, the one of these four kind of traditional value sectors performing quite well and outperforming the market from the April market low. It was outperforming going into the lows as well, by the way. Now, the problem I have right now with industrials is a lot of them have had really good runs. We've seen really good runs in defense stocks, seen in other groups as well. This is Republic Services, RSG. They may collect your trash depending on where around the country that you live and who does your trash collection. But I would tell you that this was a chart I shared with my Market Misbehavior Premium members this morning, just to sort of remind them the difference between price going higher on improving momentum, which was what we saw from RSG in January and February, to prices going higher on weaker momentum, which is what we saw in April and May. So you have the market going higher here on weaker momentum readings. That's a bearish momentum divergence, suggesting a different vibe, right? We're making new highs all through this period. Every month, we're making a new high from where we were the month before. But there's a big difference between making new highs on stronger momentum and making new highs on weaker momentum. I'm seeing that bearish momentum divergence in a number of charts in the industrial sector, and indeed a lot of other charts that were going higher up until this point. All right, CVS, obviously in the healthcare sector, a lot of healthcare names getting dinged here, pretty good. 3% down today for this pharmaceutical stock. Again, what concerns me here, speaking of bearish momentum divergences, the reason why I want to highlight this chart, look at what we just talked about with RSG and making higher highs on weaker momentum. Here, we're seeing higher highs on weaker momentum. This is a bearish momentum divergence from that February gap higher. We've made new highs in March and April into early May, but each one of those new highs have been marked by weaker momentum readings. So we're seeing deterioration going into the peak. We have what's probably called an exhaustion gap with a gap higher, a lower close. We fill the gap immediately. We've now made a lower high this week and we're rotating down. Breaking the 200-day moving average would kind of be the nail in the coffin for this stock that had done quite well. That would actually close the gap essentially from the February gap higher as well, which was, I think, an earnings announcement. We're seeing weaker momentum, weaker relative strength. I think CVS is a dangerous chart here. And certainly if it gets below the 200-day, that would be a problem. All right, final chart, and then I'll take some questions and we'll be done for the day. Alphabet. I actually wrote about Alphabet earlier today for CNBC Pro. If you follow my work there, you may have seen that one. As the day progressed, I wrote that sort of right after the open today. You can see what happened through the course of the trading day today. We got up to around 177, we'll call it, but then we closed back just below the open. We closed almost exactly at the 200-day moving average, and that candle right there, if you remember, here's the test. If you were watching the show yesterday, we talked about this particular candle pattern. We talked about how you can't call it something, but you have to call it something else because it's happening in an uptrend. Do you remember what this hammer? I almost slipped. Do you remember what this candle is called? It's not a hammer. It is not a hammer or an inverted hammer. It is indeed, Larry. Well done. First to answer. It's a shooting star candle. Shooting star candle, right? It looks like an inverted hammer. If it was happening in a downtrend, you would call it an inverted hammer candle. Here, and if you remember on yesterday's show, I held up my notepad with some scribbled out notes about the different candle patterns. That one's called a shooting star candle. It's bearish because when you see it in an uptrend, think about what that means. We opened here, here at the top of the body, we traded all the way up to this point, but by the close, we're back down to the low. So it tells you the intraday sentiment kind of shifted from bullish to bearish, and so that candle coming up in a bullish trend is not encouraging. Now, candle patterns are not long-term signals, really only is designed to tell you about the next 1 to 3 bars. But again, Alphabet flashing that going into the long holiday weekend, not great. So I would say the sell-off, the late hour sell-off today, charts like Alphabet stalling out and giving the negative pattern. Youch. All right, let's take a question or two. Funny story. As we started here, the StreamYard, which is the platform we're using, wasn't updating. So I wasn't seeing any comments. And I was thinking, boy, everyone's kind of quiet today. I guess this isn't much to talk about. Then I refreshed it and saw there's plenty of things you guys are talking about. So I'm glad you're here and glad you're watching. Kevin asking about IBD Live. And thanks for watching my show here. I am indeed. I'm going to be on IBD Live tomorrow morning. I know that's a premium thing for you have to be an IBD Live subscriber, I believe, to access it. It's a fantastic group. I've done that a number of times. It's a tough time for me, but a lot of those guys that are on that show are based on the West Coast, based in LA, which is where O'Neill and Company is based. You know, we're jumping on a call at 6 a.m. local time for me tomorrow morning to kind of test the audio, video, and discuss a plan for the show. But if you've not tuned in, it's a lot of fun. And if you do, I hope you enjoy the discussion tomorrow. I prepare a little bit, but in the end, it's a very organic kind of fun conversation where we just throw charts around. And some of those guys, I mean, I followed a lot of their work. Mike Webster's, I would argue, probably the most under-known and underappreciated technical analyst out there. He's designed a lot of the quantitative models that O'Neill subscribers use. He's usually on there. David Saito Chung, whose work I have followed for years. I used to read his column every day. I'd get the paper at the newsstand and go through his comments to try to learn about investing, and being able to talk with them about the market conditions is a ton of fun. So I am on that tomorrow. So I think it's 7:30 to 8:30 my time, if I remember right. Let me look here. Yeah, we start at 9 a.m. Eastern for tests. We kind of get ready around 9:20 Eastern time. So it's just before the open. And then we run through around 11 a.m. Eastern time. So hope you can tune in if you follow IBD and do all that stuff. Richard, thanks as always for watching. You said, with the coming holiday weekend, traders normally take profits to protect their assets. Would this be market psychology or just normal market dynamics? Oh, interesting. Yeah, I mean, I don't know what you would label it. I mean, I think it's just normal dynamics, right? I mean, anytime there's a long holiday weekend, usually the day before the holiday weekend, general playbook for like a Friday before Memorial Day would be lighter volume and kind of drifting higher. And randomly there will be some big news, but like no one's floating big news usually the Friday before Memorial Day. Everyone's kind of in 3-day weekend kind of mindset. The junior traders are the ones driving things on most desks. So I would say most likely lighter volume, you drift higher a little bit. That's kind of the normal playbook. Anything other than that would be pretty unusual. But we'll see. Again, these are uncharted days. These are crazy. This is a crazy year of so many normal assumptions being completely turned on their side. So maybe tomorrow's a big directional move, but usually not, right? Usually lighter volume, less directional move, and drifting slightly higher would kind of be the way that I would do it. But what you implied about that is absolutely true. That's usually what you would observe. Jeremy, thanks for watching on YouTube. You said industrials still look like the best sector chart. Healthcare looks terrible for sure. I don't disagree. I think those, I would agree with you, right? I mean, I think as an investor, right? I mean, at least what I do, and as a strategist, I'm thinking again, talking to Chris Verone earlier, it's like at any given point, you kind of have your mental list of 1 or 2 sectors that you think look pretty good and 1 or 2 sectors that you think are pretty rough. And I will tell you, if you ask people that do what I do, they can usually offer up with you just ask randomly on the street, 2 top sectors, 2 worst sectors, they'll be able to throw them out there with no warning. And I'll tell you mine. I mean, industrials for sure. Technology would be the second one. And again, things you can be concerned about with some of those, like divergences we talked about, but from a trend perspective, the 2 strongest from a trend following observation. The negative ones, energy and healthcare, hands down. Could there be reasons why energy goes higher? There definitely could. And I will tell you, that's one of the things I enjoyed about my interview with Jesse Felder, which was earlier this week. We just released that last night. Check that out on our YouTube channel. He's awesome. And talked about energy, talked about basically a rotation into energy stocks. Now he's looking at some pretty long-term monthly charts to make that assessment, but I will encourage you to check out his point of view. For now, energy is a pretty underwhelming relative performer, and healthcare has been an absolute disaster. I think you're onto something with those 2 sectors that you identified. That'll be it for today. We're going to take a long holiday weekend along with many of you, but we will be putting out some content tomorrow, particularly a show. We'll be doing an all mailbag episode. We'll most likely be taking Monday off, and we'll be back live on Tuesday with another show. But hope you can tune in tomorrow for our mailbag episode. Some really good questions that have come in. I mean, as I told you at the beginning of this year, when I started talking about a potential top going into February, and then things starting to roll over and how to put it all in perspective, I have learned way more from bearish years than bullish years. 2022 kind of years, you learn a lot about risk. You learn a lot about managing your mental, stability, about how to navigate things during challenging periods. Bull markets like 24 or 21 are boring, right? You can get away with so much. You don't have to be that good at picking stocks. You can just pick some random ones. Years like this, you really have to put in the effort. And I hope what we talk about on the show allows you to do that. That'll do it for tonight. Have a great evening, everyone. And remember, it's always a good time to own good charts. Good night, folks.